Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Today's topic is why residential property is the worst asset to own in retirement. Dallas, your topic, very strong name.
Thanks, Michael. Yeah,
you haven't been around the bush.
I was gonna name it something different, like, you know, isn't the best asset, or, you know, maybe it's worth. And I thought, no, this is what I think. This is how I feel.
Reconsider purchasing a residential property, but you've come out. I like this. Like, you haven't. You don't have a foot at either camp. You have made a strong.
As I say it, though, I think there probably is worse assets to own in retirement. You know, casino chips, things of that nature probably are probably less good than residential property. But in terms of the main things that we look at, you know, what assets do you want to be invested into when you retire? You can really only be in cash, property, or shares as a rule of thumb. And so within each of these, there's all these different categories. But when most people in Australia think of property, they think of, you know, I'll own a residential property and someone will rent that off me and I'll live off the rent, or some variation of that, or I'll own a few properties and I'll live off the rent on those. So today I want to talk about why that strategy is, I don't think, a good one, and probably there are many issues with this strategy, and I thought I wanted to go through and just rattle through them and explain why I think that's the case.
Right, let's go now. The audience, just note that Dallas has said that this should be a 10-minute podcast. In the phone call that we had before we start the podcast. So let's see. Let's go.
Let's go.
Point number one.
It's probably one of those things. Do we call it a podcast, or is it just a rant? Me going on a rant for 10 minutes. So point number one is it's illiquid. So what we're talking about here is, if you have $1 million saved for your retirement and it's tied up in 3 residential properties, all worth $330,000. The whole point here is that if something happens in your first year of retirement and you need to pull out $10,000 or $20,000, or if you need to spend more each month than what you're getting from your net rent, you can't go in and sell 50 meters of the backyard or the bathroom of one of those properties. It's illiquid in that you have to actually sell one of those properties in total to be able to access that equity.
Look, it is, and you need a lot of it as well, which I think you're going to mention in point 2. You need a lot of it to actually pay you enough to live off.
Yeah, exactly. So being illiquid is the problem. It becomes a problem due to the second point I've got here, which is the net yield is low. So like I said there, people sort of talk about, okay, well, I'll own a few houses and I'll live off the rent. It just doesn't tend to happen that way, because what I think people do is go, well, I'll have this property that's, you know, $300,000, $350,000, and I'm renting it out for $300 a week, or whatever it is. They see that top line figure, but they don't think about what the net yield on that is after you've taken all the costs into account.
No, that's spot on. I'm going to rant now because
this is actually your favourite. Given that you own a home, you know about all these costs. You can't be tricked with this sort of thing.
Well, yeah, I own the house I live in. I don't own a rental house. I used to back in the day, back a long time ago. So I sold it because I thought it was terrible. But here's the thing. So people tell me all the time, oh, but I'm getting $400 a week rent. And when you pitch your $400 every week, it's nice because you pitch out 8 $50 notes, and you can feel that thickness in your hands, and you can see the shine coming off them. But when I actually say, okay, well, hang on a sec, let's look at that. For $400 coming in every week, look, if we look at your rates and water, that takes away $70 of that $400. If we look at your home and contents insurance, that takes away another $70. If we look at the fees that you pay the real estate, that takes away about $40 at that point. If we look at the maintenance, it takes away $80 or more. And people argue with me all the time, and this is where I really do rant, because they say, "Oh no, it doesn't cost me anything to maintain," and so I've kept the numbers on that. So look, when you're taking away all of these things from that $400 a week, what you keep is about $150 a week, and that's assuming that there's no loan on the house. Now, look, it's vastly different. $150 of what you get to keep is vastly different from the $400 that someone's picturing.
Yes.
And that's the point before you mentioned where the yield is really bad and it's a liquid, in that you need an awful lot of, given that the average couple that we see in retirement spends about $70,000 a year net of tax, you need an awful lot of
fully paid off
properties to considering that from every $400 a week in rent that you get, which is about a $500,000 property, by the way, as well. For every $400 you get to keep about $150 from it.
And that ties into the next point here, is that yield is not guaranteed, and so the yield is either that maximum amount or it's nothing. So you're either getting $400 a week in rent, or your tenant's not paying the bills and they're being kicked out and it's vacant and you're trying to find someone else to move in. So, but the second part of that is, not only is it not a guaranteed yield, nothing's guaranteed in life, but that yield isn't guaranteed, but those expenses are guaranteed. So whether you've got a tenant in there or not, you still have to pay your rates, you still have to pay your maintenance, you still have to pay your insurances, all that kind of thing. So that's the other side of that equation as well, is that not only do you have $400 coming in and probably $250 going out, if the $400 stops coming in, you've still got to come up with the $250 to go out.
That's right. Next point.
So this is, I guess, the other part of it is the risk that I think of with this is it's very hard to be diversified when you own residential properties. So like we've said before, the average person that comes in to see us, they really need, they're living on $60,000 or $70,000 a year. They probably need, by the time they retire, they'll need close to $1.6 million saved. So even if you own four investment properties fully paid off, that's only an exposure to 4 different households' incomes, if that makes sense. So if you've got your tenant, they might be the only person in Australia who's lost their job this week. The rest of the economy is going gangbusters, everything's going fine, but you are really only limited to the exposure of the financial situation of that household. So it doesn't help. It doesn't help to go, oh, well, unemployment's really low, but my tenant is the one person who lost the job.
Well, that's right, and we see geographical pockets of this, don't we? I mean, we see people that may have 4 or 5 properties. Generally speaking, they're all in the same. They're all in the same city, which carries its own geographical risk. As in, if there's a downturn just in that city, which of course there are from time to time, geographical downturns when the rest of the country can be growing at a faster rate. So look, it's certainly well and truly less diversified by millions of percent, without getting too technical, than it is actually being invested in, say, a broad group of the largest companies in Australia and the largest companies around the world. So you're well and truly diversified more than being spread across 4 or 5 properties in the one city or the one state.
And that's a good point too, because if you think of most people, when they think of, if you said that, if their retirement plan was to own 4 houses fully paid off, and they said, I want to be diversified, so I'm going to own one house in a few different states, or I'm going to own a house in a few different cities, or however you want to skin that cat, you still run the risk of you are directly linked to those households. So you have what we're experiencing at the moment. People's incomes are dropping. It doesn't really help to go, okay, well, I've got a house in Townsville, but I've also got a property in Central Queensland, and I've also got a property in New South Wales somewhere. You're still linked to one whole economy, one lot of wage growth, one lot of I guess there's one country kind of thing. So there's a real limit to how much you can be diversified when you own residential property.
Yeah, absolutely. Good point.
So that, I guess, ties into another one here is that once you've normally gone through those points with people talking about the yield, and we're talking about yield, they're talking about obviously the rent that you're getting. And if people kind of go, yeah, that's not too bad though, but what'll happen though, even if I'm not getting all this yield, there'll be capital growth, and then I'll sell it. I own this house that's worth 400 grand, but in future I'll sell it for 800,000, and then I can live on that kind of thing. So what we tend to find is that there's a real mismatch of what people think that capital growth will be in future, and the fact that it can grow, for exponentially forever and a day. One of the points I've written down here is that capital growth on your property is bound by wage growth. So you've probably got a better way of describing. I feel like I'm sort of struggling to get my point across here, Michael. Do you know what I mean by this, don't you?
Yeah, absolutely. So at the end of the day, the price of something that hasn't changed. Now, what I mean by that is that a 3-bedroom house that was a 3-bedroom house in 1985 is still a 3-bedroom house today.
Yep.
So there's been no value change in that. So what you've seen over that period of time is a price change.
Yep.
And the price change, just to use the example, it's grown from $100,000 to $250,000.
Yep.
Depending on where you are, obviously.
Yeah.
But what you've seen is a price change, not a value change. Now, that price change is largely driven by two things. One that you mentioned is wage growth. So over time, people's wages
people earn
more
money. Yep.
People earn more money. That's the biggest determinant of that.
Yep.
And number two is inflation, I guess, which wage growth is a subset of inflation.
Yeah, of that.
Now, that all comes from economic policy, where the government or the central bank actually injects money into the economy over time because they want the cost of things to go up slightly. We won't even get into that.
No, but I guess that's a good point of where you're talking about that. I guess to make it concrete, if you said someone's earning $1,000 a week at the moment, and they're paying $300 a week in rent, that's probably fine, sustainable. They can do that. They can't pay $600 a week in rent until their wages basically double, assuming everything else gets more expensive. If someone's earning $1,000 a week and they're paying $300 a week in rent, and you try to put the rent up to $600 a week, well, they just can't pay it. They just don't have that spare money. So
they can't pay it, and the market as a whole can't pay it. And there's always an abundance of residential property to rent. So you are bound by market forces. Those market forces are supply and demand. So you can't, like you mentioned there, you can't just double the rent, or you can't put up the rent significantly because of there's just so many other supply options for people to actually go and rent. Most of the time, ignoring certain geographical pockets, of course. So look,
and across the board, it's an interesting one because I think what you tend to find is that over extended periods, capital growth can bounces up and down within a range, and so things might the price of a house might double over the course of 5 years or 10 years. But it's a dangerous thing to extrapolate that when your plan is to be retired for 30 years. Just because something has gone up over 5 years or 10 years, you can't really draw a line through that. And say,
I was going to mention that. Look in Australia, and there's only a few other places in the world that have behaved like Australia's behaved over the last 40 to 50 years, which is we haven't seen a significant downturn in property prices in Australia. And look, there's many different factors that go into that. One of such is our population growth as a percentage has been huge over that period of time. So we've had net immigration as well, where other countries haven't had that as much as well. Look, it's certainly going to happen, and even the global financial crisis when property prices in New York and Los Angeles and London and all of those types of places were actually dropping. It actually didn't occur that much in Australia. So you have these generational, I guess, rules of thumb that look, if I buy property, it's going to double every 7 to 10 years, and so I won't buy one, I'll buy 2 or 3 or 4 of them, and I'll use leverage to do that, which you have to do. I mean, you actually have to borrow to do that.
And I think that's
it's a
probably
situation that's just been the baby boomer generation, and Generation X just hasn't seen that happen yet, but it will happen at some stage.
Well, I guess it's easier. So in Townsville in particular, where we're obviously based, this is an easier conversation to have with people now compared to 10 years ago.
Absolutely, and it's an easy
because property prices haven't really gone up in the last 10 years. And so,
well, Dallas, they've dropped. They've actually dropped. Like people will tell you they've gone sideways. They've dropped a considerable amount. Yeah, and it's because sales get reported. I feel like we've probably been labouring too long on this point, but and you've got it down as a point to mention as well. But certainly, certainly prices have dropped in the last 10 years. Absolutely.
Yeah, and so that's the where this gets into, and like we won't get into, that could be a whole podcast in of itself of what drives the price of assets and all the rest of it, and what's that likely to do over 30 years and all the rest of it. But basically, if you look at what an asset, the return on an asset is made up of, it's the yield and it's the capital growth. And so, given that not only is the capital growth, it's bound by wage increases and how much people can actually afford to pay in rent in the future. There's also significant volatility in that. And so your house that, at the moment, right now, if you went to go and put your house on the market, you've got no idea what you would get for that. And you potentially you may not really be able to sell it at any sort of figure that you'd be happy with. So it's kind of those things where, like you're saying, it doesn't feel like it, because for a lot of people, if you go to put your house on the market and then it doesn't sell at the price you want, you take it off and it doesn't feel like it's dropped that much in value, if that makes sense. Whereas if you were forced to sell that.
I guess the analogy that I use, so people tell me all the time, they say, companies are risky because the price drops. And I say, well, so does property. And they look at me like I have two heads. And the whole reason that share prices of companies drop is because you have a guaranteed buyer for that share. That second you want to sell, you have a guaranteed buyer. It's just that you have to accept the price that they're going to pay. So right now, the guaranteed buyer will only pay 70 cents in the dollar. Now, if you were to auction your house every single day for 365 days of the year, you would actually, to get a true value of that house, you would actually have to take the best offer on that day. And talk about volatility, you would see absolute wild swings.
Man,
you would see one day there'd be no buyers around.
Wouldn't this be a great way for you to really annoy your real estate agent mates? Just say, hey, I'm trying to run an experiment. I want you to auction my house every weekend for the next 52 weeks just to see what prices we get for it. They wouldn't do it for that, but also,
especially in geographical pockets, you could put a $400,000 house on the market. Look, sometimes you'd be having to drop it by $10,000. Here's the analogy: you have to be dropping it by $10,000 every 10 minutes. Someone didn't buy it at the price that you had it. Until such time as someone comes along and actually says, I'll snap that up. Now, sometimes that house would get to $250,000 before someone said, yes, I'll buy it. Other times it'd be $410,000 or $420,000. So you'd see the same wild fluctuations. All volatility is the price that you would get for that item that very second or that very day. And again, without labouring it too much, look, it's extremely volatile. Like the prices of houses are extremely volatile. If you had to sell at that point in time, then you would see the price swings significantly.
So I guess that's where, to sort of summarise that's I guess my 2 points there with everything that I've gone through already, is that your yield isn't guaranteed. We're not even guaranteed, but your yield isn't something that you can sustainably rely on to live off, and your capital growth isn't something that you can sustainably rely to live off either. You know what I mean? So that you sort of of those two, you don't have certainty of either of those, even though it feels like a safer asset. And that's kind of my thing, is that no one's saying you shouldn't be invested into volatile assets, but you should go in with your eyes open, knowing completely, okay, is this something that's safe, or is this a defensive asset, or is it a growth asset? And I think that's where residential property gets mischaracterized as a safe asset, when neither the yield or the capital growth on that is a safe bet.
That's right. And I think people think ultimately it's safe because they can drive past and check it.
Yeah.
And we've talked about this before, how you can be diversified across 1,700 companies in Australia and around the world, but that comes to you on one piece of paper. So
it doesn't feel the same way.
Your statement from your investment fund manager that has you diversified across 1,700 different companies comes to you on one piece of paper. So it actually you hold up a piece of paper next to a house, and it doesn't feel diversified at all. That piece of paper. What feels more safe and secure is the bricks and mortar that you're looking at.
Yeah.
So I think that's
the thing with you completely understand with all of these things. It's something in Australia in particular that I can understand, I can empathise with why that feels that way. Like it definitely makes intuitive sense if you drive past a house and you can look at it and you can touch it and go, I can see my tenants in there cooking dinner and they're going to pay me rent because they want a roof over their head. It feels like something tangible and easy to understand. It's just one of those things that the numbers do not stack up.
No, that's right.
So a couple of final points before we finish this 10-minute podcast. It's gone for probably 20 minutes already. So the second last point, which is a bit more of a technical point, which is something that we talk about at great length, how to best invest your retirement savings in retirement when you are drawing out on a regular basis. And like I just said, you want some assets invested in growth assets and some in defensive assets. Now, the problem with having residential property is that every now and then you will get a big maintenance bill. And so what you actually need is a fair bit of cash set aside to meet those bills. So not only do you, like I just said, not only is that asset itself not safe, it's basically your residential property is a growth asset. You need more money. You can't have all of your money invested in houses because you need some cash sitting there so that when something goes wrong, when there's something wrong with the roof or the air conditioning is replaced or whatever. So you basically can't have all of your money invested that you probably wanted to have invested anyway, because there's a cash drag on that investment.
Yeah, that's a great point. It's a point that I haven't ever given much consideration to, but you're right. And to have enough residential property to pay you enough income. Like we said, you need to fully own at least 3, 4, 5, 6 properties to be able to pay that income. So so
imagine,
you would have to set
you own 6 properties, something's going to go wrong every year.
Yeah, you have to set aside quite a lot of cash. Just for even Murphy's Law that 3 of the 6 properties required a big maintenance project.
In
one particular year, all at the same time. So
So that cash drag, that's probably another podcast in and of itself. So I won't labour that point too much either. But that is something that I was cool about.
Sorry. I didn't realise you were trying to look to pick a fight there, Dallas. When you fail to move on, the audience will be scratching their heads thinking, "What are these guys about?" So Dallas and
I don't know.
We have an ongoing debate about how much cash to hold when you're in retirement as a retirement portfolio. So we'll talk about that at another time. But
so my final point with this 10-minute podcast, which is from a very lazy man around the house, which is me, is that there's just work involved in managing properties, and there just is, and there's no way around it. Doesn't matter whether you've got an agent or whether you do it yourself. it's not as easy as just saying I'll hand that over to an agent and they'll take care of it. So separate to all of the other issues in terms of your financial situation, there's also the lifestyle choice of, do you want to be stressing about that and worrying about, is my tenant taking care of it or not, or is my agent doing a good job of managing it or not, and what else can go wrong?
Yeah, absolutely. Look, whilst an agent's managing it, it doesn't absolve you of all of the decisions that you need to make and all the things that you need to get involved in, of course.
Mm-hmm.
And look, we've heard multiple stories of people that are disappointed with their real estate agents and the way that they've managed as well. So, in many cases, they're paying for something to free up their time, and then that hasn't worked out, and they've had to move that agent on and move a new agent in, which has caused quite a bit of work, and I guess mental anguish as well. So.
Yeah. That's the other part. Is the not just the work, but I guess the mental energy of going. It's just a decision to be made and something that you've got to worry about and got to think about. So, anything else that you've got to add there, Michael?
The only thing I was going to add is for all the listeners out there, whenever we say, I think the new rule of thumb is when we say something's going to be
10 minutes,
10 minutes,
half an hour,
triple it, and if we come in underneath that,
mate, we should do the reverse of the. We should do the reverse with our budgeting for time for a podcast, as what I do for clients when they talk about how much it's going to cost to maintain their property. If they tell me it's going to cost $10,000 a year, I assume it's going to cost $30,000 a year. So when we say it's a 10-minute podcast, it's probably a 30-minute podcast.
Good place to wrap up.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.